If we look at the PE ratio for stocks across different industry sectors, it's quite obvious that the tech industry has been largely inflated in terms of its stock price, with a very high PE ratio of 37 for the XLK, which is an ETF that consists of internet, software, and service companies, including Microsoft, Nvidia, and Apple. The Nasdaq 100 Index ETF, QQQ, is also very high in the ranking with over 35 PE ratio. The components of QQQ nowadays are essentially the same as XLK, with a slight difference in weightings for different companies. Both ETFs are dominated by tech stocks, and their performance will be determined by how these tech companies do in their quarterly financial reports. Even the SP 500 Index ETF SPY has a high PE ratio of 26. Other industries like financial services and industrial materials are having relatively normal PE ratios around 16 to 18. And the energy sector, represented by XLE in this case, has the lowest number of 8 PE ratio. So you can see the tech stocks are over 4 times more expensive than energy stocks if we are just talking about their stock prices compared to their earnings. Of course, stock prices are being traded not based on its current earnings, but largely based on future forecasted earnings. However, if the Wall Street goes too far to create such a massive bubble of tech stocks and sells the AI gene to the general public, there's definitely a time point in the near future when everyone suddenly realizes that it's just a distant fancy fairy tale. And that's when the stock market will crash really hard. Apple, Amazon, and Nvidia are all great companies, but it just doesn't make sense for an investor to buy some really good stocks for $100, while it's actually worth of only $70. The big sell-off of tech stocks have already started in July of 2024. As Bloomberg reports, there has been a total loss of $6.4 trillion in asset prices over the global financial markets over the past 3 weeks. Jensen Huang, the CEO of Nvidia, sold $322 million of Nvidia stocks in July. Warren Buffett, through Berkshire Hathaway Corporation, has sold half of his Apple stock holdings and cashed out over $840 from the market in the second quarter of 2024. Buffett also thinks that all stock assets are overpriced right now, and he does not want to buy large numbers of stocks at the moment. On the other hand, Berkshire Hathaway has now accumulated over 2,300 billion short-term US Treasury bonds. CNBC reports that Buffett now owns more Treasury bills than the Federal Reserve. By his trading activities, we can see that Buffett's negative view of the current stock market and the economy is very obvious. We know Buffett had a famous quote that investors should be fearful when others are greedy, and greedy when others are fearful. Clearly, right now, Buffett is very fearful, while the majority of us are greedy. As retail investors, we can learn from what Warren Buffett is doing to prepare ourselves for the potential economic downfall and stock market crash in 2025. If we can change most of our positions from stocks to treasury bonds or even cash, while the stock price is still high, then in the coming months, when the stock market really goes down hard, we would have lots of money to buy stocks at much lower prices than today. And then we can hold the stocks and wait for the true bull market to return and see our investment accounts grow in huge numbers to become financially free eventually.